Let's get started. This webinar is dedicated to such interesting and unusual topic as trading with market profile. It is not so popular tool among currency traders or forex traders because traditionally it was used by futures traders who were involved in trading stock indices such as S&P 500 and others. But the convenience of market profile allows to use it not only for exchange traded products like stock indices, futures and other, but also it can be used for trading currencies. And in this webinar I will show you how to install and use special custom indicator for MT4 trading platform to build and employ market profile in your trading. I will tell you about basic principles, techniques and methods that you can use trading market profile. I will show you how I use market profile in my trading. And I invite you to listen and make notes if necessary. Most of ideas discussed here were somehow used for trading either for me or students of my educational groups, so they are based on practical experience. Now we are ready to start. And before we start, let's take a quick look at the disclaimer. Please beware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts on a simulator using historical backtests before putting real money at risk. First, let's start this webinar with basic terms and definitions. And the first question is, what is market profile? It is an unconventional charting technique that employs the same principle that is used for building Gaussian normal distribution. And unlike traditional charts where we can track market action as time passes by, market profile helps us to measure activity of the market around certain price levels. If you are familiar with normal distribution, you should remember that every random set of data eventually can be described with this distribution. If you are not familiar, I will explain it for you in a nutshell. Imagine that you want to measure ability of the market to generate trending moves, which is distance between open and closing prices. How do you think? What are the odds that today you will see trending day with 200 pips of volatility? Odds are not so great, and you will much more likely see average volatility of 40 to 50 pips. It is going to be average number or a mean, which can be placed here. It is, for example, 40 to 50 pips of volatility. Also, odds are not so good that you will see very small volatility of 15 pips or less. It is also will be located here. Or the very big trending day with 200 or 300 pips of volatility. If we take, let's say, 200 days or 1000 days, and measure frequency of outcomes for each event, we will likely see normal distribution. And the first thing that we can capture from this distribution is that 68% of data falls into one standard deviation. It is shown by the dark blue here. And the rest of the data is consolidated at the distance of 2 and more standard deviations. So if you want to have 70% of positive outcomes, you should operate within one standard deviation and not try to capture big trending days. Well, in reality, markets are not so random. Sometimes we can see sequences of trending days with very large volatility. But this is just an example. And we can not only take 1000 days, we can also count bars or candlesticks within one single day. In other words, we can try to calculate number of bars touching certain price level within a day. And when we do this, we can get very interesting perspective of what is happening. We can build market profile. So if we turn this graph this way, we will get market profile. Market profile will show you how frequently every price level was traded within a single day. There is also such thing as volume profile, and in this webinar we will talk about market profile. Market profile is different from volume profile because market profile shows you number of events when price just touches the level. On the other hand, volume profile shows number of contracts traded around certain price level or different price levels. They can be similar or they can be slightly different. For example, market profile can look this way, volume profile can be visualized like is shown here. Futures traders can employ volume profile because they have transparent volume that they get from the exchange. On the other hand, Forex traders can use market profile because they don't need to see volume, and these profiles can look pretty much the same. But in this webinar we will talk about market profile that can be used without any information about volume. All we have to know, price and time. When we watch conventional charts, such as candlestick charts or bar charts, which are widely used by traders, they often can create an illusion that trend is developing, that it is going in whatever direction. Price is always moving in terms of closing higher, closing lower than the previous bar. And too often traders lose perspective of what is happening on the higher time frames. They lose feel of the context. They just focus on the right side of the chart. Their attention is sticked to what is happening right here and now. It may be not too good because we don't want just to trade the price. We also want to know where value is. And when we lose the feel of the market context, if we don't know what is happening in the broader picture, we may be confused about price action that can generate many false movements. If we just go after the price, we can end up buying highs and selling lows. It can be very frustrating experience. As I have said before, normally there are two ways of building a profile. First is a market profile and the second is a volume profile. We will talk about market profile. The classical method of building market profile, which I will share with you in this webinar, will look like the following. Market profile is built from letters which are called TPOs. It is abbreviation for time price opportunity. TPO is a letter which indicates certain time period within a day. Each day starts from O, which is opening. Then we can see A period. Every price traded in the A period is indicated in a profile. For example, if there has been wide range in the A period, we will see elongated column consisting of A letters. Well, I will not pay too much attention to the opening price because it was important for futures traders or stock traders when they were dealing with the market that had opening and closing bell. Forex market does not have any opening and closing bells. It is traded continuously 24 hours a day. I also must mention that most of futures markets now are trading in continuous mode. They don't have anymore any closing or opening. And market profile was designed in 1985, and that's why it has opening price. Well, don't pay too much attention to this price. It is just an element of the profile. Then let's imagine that at the first 30-minute period, which is A period, price had reached 1.0626 level and reversed after that. We will not see this reverse, we will only see range of the A period. It is range extension. Then we will see the range of the B period. Letter B will be added to a vertical scale. Well, it is not so easy to identify where A period had finished and B period had started. To be able to view this, we have to switch to candlestick chart. And in my trading, I always watch profiles along with candlestick charts, just to be able to see the complete picture. Candlestick charts give me the perspective of destination of the market, while profile shows levels, areas, and other important information. On this slide you see how market profile really looks like. When we use indicator TPO chart for MT4 trading platform, we have the profile looking like this. We have a black background and we have yellow or a green chart, and we have a profile itself. And what does profile consist of? And first of all, it is value area, which is considered to be blue rectangle aggregating 70% of data or 70% of letters which market profile consists from. What does market profile consist of? And first of all, it is value area. It is a blue rectangle that aggregates 70% of data or 70% of letters which market profile consists of. Remember that each letter represents 30-minute time period. Secondly, it is point of control, which is considered to be the fairest price to do business for the given day. And this particular example shows normal day, or the day with one point of control, but sometimes they can have up to 3 points of control, or even more. And when traders start learning to trade with the profile, they pay too much attention to levels such as point of control, value area high or value area low. But market profile is not a crystal ball. It doesn't give you any trading signals. It doesn't tell you where to buy or where to sell. It is just a framework for analyzing the market. Well, sometimes you can place your trades on the point of control or even value area high or value area low, but it must not be too mechanical. We are not talking about market profile, we are talking about trading, and decision making in trading cannot be very mechanical. Well, there can be mechanical trading systems, but it is the wholly different topic. We are talking about discretionary approach, which includes being aware of analytical context or market conditions and many other things. But before talking about any strategies or methods with the market profile, we have to talk about profile building blocks. And the last but not least is a spike. Spike is a single print area located at extreme points of the profile. And I haven't included here one more component which is very important. It may be called minor development area or a single print area. It is often located inside of the profile. Later on we will talk about how to use all those references in trading. Now I'll explain you how to install TPO chart indicator in your MT4 trading platform. You will find all necessary links below this video. You will be able to download the indicator and install it in your trading platform. Then you have to set black background. For example, you can choose green or black. Then you go to indicators, custom, choose AY TPO chart version 1.02, and you have several parameters here. For example, the first parameter is look back. You may want to choose how many days you want to look back to. For example, I can choose 25 here. And also I will place false on show profile info. And that's what I have. That is a profile. Now I am having profile established on Euro versus Japanese yen chart, and you see that I have candlestick chart aligned with the market profile. Now let's start with quite simple things and move on to more complicated things. First of all, in trading we have to distinguish value from price or signal from noise. And when we use conventional chart like candlestick or bar chart, we can use some substitute of value like moving average, for example. But it is not very reliable, yet the principle is pretty much the same. To see the real trend of the market, you want to see how value is moving, not price. Price is always moving back and forth, and amount of conflicting information can be overwhelming. To filter this information, traders often use indicators, which create continuous curve that is always moving somewhere. Well, in this example, market profile is also an indicator, but it shows you separate value areas for each day. Here we can analyze each day in relationship with the other, and as I have said, it is very basic and simple observation. It is not an edge yet. But it is the first thing that we see watching the profile. We see the destination of a real trend. And here we have a couple of important nuances. Value areas can overlap each other. Overlapping value areas are shown here in a trading terminal. When you see such kind of trend, you understand that market is trending, but also it is balanced. Also, you have a component of a balancing market. The more overlapping days we see, the more balanced market is. And if you see that value areas of 2 or 3 consecutive days don't overlap, it might be a sign of young or emerging trend. When you combine this observation with your technical analysis, you may confirm your hypothesis. For example, here we see that value areas of 2 days of January 28th and January 29th, they don't overlap. We see a large gap here. But that's not what we want to see. It's a very large gap, actually. When market breaks out of a balance, we see that value areas don't overlap, like it is shown here. Or overlap is very small. Absolutely no overlap between January 4th and January 5th. Of course, market is balancing later on, but for some period of time it is an indication for a strong trend, and price gravitates to achieved lows because the trend is strong. And you see several days with value areas without any signs of overlap. Value areas aggregate into areas of balance. To see whether breakout was real or fake, we want to see the gap between 2 areas of consolidation. From the example on this slide, you might see that real trading ranges overlap. We see it by these highs. But trading ranges built with the help of the profile, they don't overlap. They are marked with red rectangles, and you see that they show you real levels of rejection. If you think that once price breaks out from a range it is going to find support on a previous extreme, it doesn't work very good because there is too much noise here. But if you filter this information with the market profile, you see real borders of areas of consolidation, and it changes your view of important levels and allows you to make much more accurate trades. For example, on this slide shown here, you see that we have 2 levels here. One level is aligned with previous extreme, and the second level is aligned with the market profile. To build this level, I use value area high taken from the previous day. It is the highest value area high for the previous period of consolidation. Real breakout has occurred from this point, but not this point. So if we, for example, place buy limit order on this level, it will be much better decision. Yet the distance is pretty small here, but if you are day trading, it matters for you what type of stop to place. 20 pips stop will be better than 40 pips stop, because in this case you might have much greater profit-loss ratio and the better parameters of your trade. Well, it is the most simple approach to apply market profile in your trading, yet it is just the framework that can be used in most simple way and in more complicated ways as well. We are going step by step from simple to complicated to show you how to use market profile for the sake of analysis and making better trading decisions. As I have said previously, normal days or normal activity don't occur in the market all the time. And sometimes market is not going to be normal, and we will see anomalies. Here our references come into play. Do you remember about single print area located inside of the day? I call it minor development area. If you see trending day with single print areas occurring inside of the day like it is shown here on this slide, it is a sign of imbalance. What do I mean by imbalance? It means that buyers are pretty aggressive and absorb most of supply, raising prices too quickly. They want to do business quickly, they are hurried, but at the same time they can't afford bringing all the volume they have in the market at once. In this case we would have seen a rapid breakout, a very big candlestick with a body of 100 pips or more. Normally it is not going to be support, it is rather a shakeout. Smart money buyers or professional buyers don't act that way. They prefer to buy at least by the average price, but not by the highest price of the day. That's why they accumulate their position in a wave-like process. They buy something at the beginning of the day, then they let the market consolidate, again they buy something, they let the market consolidate, then they buy some more, and finally they buy some more after the closing bell or before the closing bell. Well, there is no closing bell in the Forex market, we all remember that. But often market continues to show ascending impulse after the US session closes. So the pattern shown here can be called double or triple initiative activity, or double or triple initiative day. On a candlestick chart you will see wave-like action like it is shown here, and on the profile chart you will observe several single print areas like it is shown here. In this day we see two anomalies or two single print areas. In the day after that we see three anomalies. The third one is a spike. It has occurred at the top of the day, and first two anomalies, they occur within a day. And also what is important is that market has built a neutral day after that. Neutral day shows us absence of activity, which is sometimes more important than presence of activity. In this particular case, market is going to take a rest, volatility dries up, and we are able to use this decreased volatility to decrease our risk from going long, for making a trade in the direction of a trend. On the next slide you see continuation of this example. I had placed buy stop order just above the value area high of the previous day. It had given me ability to place pretty tight stop because of decreased volatility and achieve very good profit-loss ratio in this trade. I remind you that when we execute momentum trade we can place our stop relying on ATR indicator, which measures current and historical volatility. And please note that the highest point of the day was not going to show us any spike, like in the previous example. We have seen what is often called poor high. In other words, momentum is gone and market is going to become more balanced, and it is a sign for us that we have to exit our position, or at least to think about searching for point for exit. That's how profile works. It doesn't give you any signals for exit, but it shows you that the odds of keeping your position are not too good here. I have exited this trade on ascending swing just here. This ascending swing had brought the price close to the value area high of the previous day, of the value area high for the current day, and you might see that this level was never broken during the rest of the day. Market was staying in a balance. On the next day we had minor continuation to the upside, but I would say that risk of keeping position overnight was pretty large. It was not worth taking. Now let's watch another example. It is also a breakout from the balancing area, which is shown here. And this breakout was supported with double initiative activity, or two anomalies occurring within a day. Actually there are three of them, 1, 2 and small spike here. Well, here we have two TPOs, but in fact we can treat to this level as an anomaly, as an initiative break, because in this case market has broken out with this candlestick and we have seen ascending trend that is followed. So we can treat this level as a single print area as well. Also note that two value areas of these days are not overlapping each other. I mean day number 2 and day number 3. They don't overlap, and as I have said previously, it is a sign of emerging trend. Well, day number 3 can be called trending day with double or triple initiative activity, or double or triple initiative day. We can build a level of rejection by the first bar or a candlestick from the day of the breakout, which is shown here. Can we build this level using candlestick chart only? Absolutely, but when you see the market profile, you capture these levels much more accurately. But you have to understand that it is not a single print that makes us buy here. The reason is not single print. It is trading idea that the market is being dominated by traders from other time frames or smart money buyers, which are shown or represented here within this day. We have to go with the strong side of the market to be able to consistently win. You can see videos from previous webinars and you see that large market participants or large speculators often go with the price or with the market action. They predict the market action pretty clearly, but we don't know whether they are involved in the market or not. We see it only with the lag of 1 week. I'm talking now about commitment of traders reports. But to see them in the real time, you will have to learn to read their footsteps on the chart. It doesn't matter what type of the chart you are using. It can be conventional candlestick chart or the profile chart. Something works better for one types of traders, while some other traders work better with other types of charts. It is just a tool. It doesn't give you any edge itself. You construct your edge from the information that you can read from this chart. Now let's talk about another important aspect of market profile. If you see anomalies that are too elongated, like it is shown here, for example, here we have spike with 6 TPOs with 6 letters. Sometimes we see single print areas located inside of the chart, and they contain also 5, 6 or 7 letters. So it is very big anomaly, and they often are filled with further market action. Market doesn't like empty levels. It fills such kind of empty levels. And if nothing really happens, if there are no big time frames involved, big smart money buyers or sellers involved, these areas are going to be revisited. We can more than likely observe continuation or consolidation within these areas of the next day, like it is shown here, or possibly after a period of 2 to 3 days. Here we see day number 1, day number 2, 3 and 4. Day number 2 repairs the structure broken during the day number 1. Day number 4 also repairs the structure broken by the day number 3. Such anomalies are often shown on the chart in the form of elongated single print areas regardless of its location. It can be spike, or as I have said, single print area occurred inside of the chart. On a chart shown here, you see so-called P day. It looks like the letter P because of elongated spike occurred right at the bottom of the market action. When such kind of day occurs at the edge of a trend, it represents profit taking but not real reversal. Odds are so that you will more than likely see continuation of the trend within the period of 2 to 3 days. So you see, we had seen new lows after the continuation. So if you know this ability of the market to repair the structure, you can build a trading idea around it. You may start searching for trade location for a short trade or a pattern for getting inside a short trade here. So you may think about going short, and it would be reasonable because you know that the market will more than likely fill this rejected area. Of course, sometimes market reverses, but the odds will be on your side if you will work in the direction of the trend. It is much easier to work with the trend than going against it. And the opposite example is shown on this slide. When we see sequence of 3 to 4 days or more, it may be 7 to 8 days, the more the better. If they are traded in very narrow range, it can be too much for one single trading range. When we see many days concentrating around one narrow range or just one price level, odds are very high that we will see moving trend later on. The composite profile of such area can look like it is shown here. The composite profile is a profile combining not just one day, but it can combine 4 to 5 days or 10 days or more. It is going to be very elongated and aligned to a limited number of levels on the vertical scale. It is going to look like that, very, very narrow. Once you see such kind of situation, it can be used for building a trading idea around it, because you know that market will more than likely emerge from this trading range like it is shown here. So you can trade in whatever direction. You don't know where exactly market will break out, but you will follow the price and you will be on the right side of the market. Okay, with that we are going to finish our webinar, and we will continue talking about market profile in the second part. I hope it was useful. If you have any questions or comments to this video, you can leave it below, and I will do my best to answer all of your questions. See you in the next video.